Hey everyone, it's Imran from Options Insight back with another macro options spotlight. Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options. Okay, US markets weighed down a bit yesterday. We saw a down 1% and nearly 2% on NASDAQ, weighed down by Fed rhetoric coming out more hawkish still, talking about higher terminal rates for longer. Same story we've been hearing for ages. And also, we did need a bit of consolidation. The tech squeeze, the tech short covering squeeze that happened needed to take a breather. Is it finished yet? We don't know. But for now, it did look like a lot of people had been through a lot of pain and were getting stopped out. And so that's taken a bit of a pause. If we look over at commodities, metals are also struggling to bounce materially. Copper also retesting supports near that $4 level. Nat gas reversing back lower pretty aggressively, down 7% yesterday. It looked like it was having a little rally, couldn't last, couldn't maintain it, but oil did manage to hold on to some gains, up like 1.5%. And then lastly, uranium's had a pretty tough time, down about 7% on the week. So that's struggling along with the whole complex, the whole commodity complex as it is, as that dollar strengthens. If we look at vols, implied vols did catch a little bit of a bid. So you can see sort of one vol, just over a vol in US indices here. So not so much in Europe and Asia. They were lagging behind, and those markets obviously just not moving as much. And we can see that in the carry side of things, negative carry in US indices, positive carry pretty much everywhere else, right? So it's just showing you that US gamma is working. It's kind of moving around more than its implied vols. Whereas if we look over at the likes of Europe and certainly Japan, we can't say the same thing. Okay. In terms of skew did catch a little bit of a bid in S&P. We saw some downside protection buying, rumors there that it was Carl Icahn buying a load of protection for February options, so expiring next Friday. It's going to capture the CPI number. I don't know whether that was actually true or not, but that was floating around on FinTwit. And we did see a bit of a bid come back. So you can see S&P skew up here, up around 60 basis points there, whereas skew in general everywhere else was kind of drifty. China skew coming down a bit, some of these tech and Russell skews coming down a bit, but India did resurge back up again, back to 2 vols, that skew. Obviously, India's a bit all over the place right now with what's been going on with that Adani group. So that's what's going on there. Okay, moving on. So what do we got? VIX and VVIX. So that's definitely standing out in terms of action yesterday. We saw a big spike in VVIX, and we didn't really see quite the same sort of move on VIX. So up about 10 points on the day. We have been flagging the VIX options flow lately, those large prints in March that went up last week. We definitely think that's got dealers scrambling a bit and short quite a bit of convexity. So that's leading to this spike in the VVIX, up 10 points in a day. Now, if you look at the chart of VVIX with the VIX superimposed on top, you do see that certainly on the way down, the VVIX has often led the VIX. So you've seen a low VVIX driving that VIX level down. Now, this can sometimes work on the flip side. We've had this big spike up here in VVIX. VIX is yet to follow, but if it was to follow, then, we're looking at VIX around 20, could easily spike back up to sort of 23, 24. And if it got to 23, 24, that would be very interesting because that's where all those short strikes are in the VIX calls that were bought in March, around the 24 to 26 zone. So if we were to start to get that, we may even get an overshoot and see the VIX kind of materially go back towards this 30 level. So that's something to be aware of. I think we do need catalysts. I think we do need CPI to spook the market or something like that for that type of move to happen into like late February. But that's kind of what the setup's looking like right now. Another interesting thing is the 2 to 10 inversion. So this is something I keep track of. That is one serious downtrend, and that has done, there's been various trends that have been established last year, and a lot of them have reversed or tried to reverse in January. This is still very much intact, right? We've got cycle lows in the 2s, 10s down to 83 basis point negative inversion. You would have thought that with the whole soft landing or no landing even narrative starting to build some traction, that we would actually see a steepening of this curve back, and that back end yields start to actually go higher. We have not seen that yet. So this trend is very much in place, and I think it's quite telling and quite interesting. It is one of the things that is still, the market is trying to say, no, a recession is happening, whether you like it or not, right? That's kind of how I might potentially read that. Okay, and on that point, if we look at long end yields versus short end yields, so we've got a chart here of 2s, 10s, and 30s on the US. And you can see if we go back to kind of September, October, where these things were at their highs, the 2s have done a pretty good job of recovering most of the move down. So yields worked their way down and they had a big pop back here, where taking the 2s back to near that 450 level. Whereas if you look at 10s and 30s, nowhere near. This is why the inversion keeps getting deeper. But 30s in particular are really struggling to materially move off the lows that they made in terms of yields. So that's that. And then if we look at the TLT, which is kind of our proxy of the 30s, but it's closer to kind of 20-year duration, you can see the TLT here. You know, if the yields were going all the way back to the highs, the TLT would sell off into the low 90s, right, which were miles away. So it did run out of steam here around that 110 area. There was a bit of a volume cliff there as well, and it's coincided with that twice. We've got one peak there, another peak there. So put in a bit of a double top. But if you look at the trend here, we are making higher lows. So if we look for support around this sort of level, somewhere between 103, 105, if we were to bounce, and then we get this upside move that I anticipate we get as a recession does get priced in later in the year, then the target up here, we're looking at the next volume cliff, and we're looking at somewhere just shy of 120. So that's kind of the target zone for me if we look at TLTs and where that could go if bonds are going to outperform as we do price in a recession later on this year. So how would I express that in optionality? Well, looking at the dashboard, what do we see? We see volatility, we see buying calls screening as the trade here. But the problem with buying calls is generally you pay carry and the volatility carry is positive. So when the volatility carry is positive, you don't really want to be in outright options. You don't really want to be in short dated options because they're just not carrying themselves, right? The realized isn't going to justify it, basically, or it hasn't been justifying it. So if we look at the curve here, the front end is slightly elevated as well. So we quite like the idea of pushing ourselves to the back, going to June expiry. We're not paying any premium for that in terms of volatility. In fact, we're getting a very marginal discount to the front there. So that's fine. And we do think if nothing happens, the curve could go into contango and we'll be protected in the fact that we've got a longer dated position. So we like calls in June. In terms of the skew is about 1 vol point, which is relatively flat. So that means call spreads look quite attractive, right? You can buy calls, you can sell a higher up call. The discount in vol that you're getting, you might not even get a discount in vol for that higher up call that you're selling. So the call spread looks attractive. So that's what rather than buying calls, we're going to park ourselves here. We're going to buy call spreads and we're going to do longer dated call spreads because we think that's a safer place to park. And also it gives more time for the recession scenario to play out and for the market to react to that basically, right? So that's the idea. If we jump over to the actual trade, okay, that's it for today. Thanks a lot for listening as always. I'll catch you all tomorrow. Cheers.